Hi John, thanks for having me. It's a pleasure to be here. So I'll briefly introduce myself and then jump to the investment idea I want to share. So I've been in markets for a little over 7 years now, and it's been an exciting journey. I run an independent equity research firm by the name of Stalwart Advisors. We are based out of New Delhi, registered with SEBI as investment advisor, and we blog at stalwartvalue.com/blog. So the idea I want to discuss is a company called Wonderla Holidays Limited. It operates three parks in India, which makes it the largest amusement park operator in the country. Uh, just some quick numbers. The market cap is $320 million. It is listed on both the National Stock Exchange as well as Bombay Stock Exchange. Uh, quick snapshot of last annual numbers. They did about $31 million in sales, $9 million of net profit, return on capital employed of 23%, and it's a net cash company. As on March 2016, they had $17 million in cash and surplus investments. So this is not a very old company. They started their first park only in 2000 in the southernmost state of Kerala in a city called Kochi. So they spent about $10 million on this plant, on this park. They bought about 93 acres land, and currently they are occupying 30 acres. They have 55 rides there, 22 wet rides and 33 dry rides. Uh, their average capacity on a daily basis is to handle 12,000 guests, but on an average last year they entertained about 3,000 guests. So their capacity utilization even today is merely 25%. If you see TripAdvisor's ranking, it is the third best thing to do in Kochi out of some 170 odd. Very good reviews, some 4.5 star reviews based on 600 odd uh, reviews. Over last 10 years, the revenues have grown at a CAGR of 15%. This is 4% growth on the back of volumes and about 11% growth on the back of higher revenues per visitor. So footfalls from 2006 when it was 7 lakhs have now grown to some 11 lakhs, and revenue per visitor, which used to be sub 300, is today almost 800 rupees. This has been fairly impressive growth considering it is their oldest park and also a mature park. In 2005, they started their second park in Bangalore, which is the IT capital of India. They spent about $15 million on this park. Again, total land is about 82 acres, roughly half is occupied currently. They have 61 rides here, 21 wet rides and 40 dry rides. Uh, Again, the capacity is to handle 12,000 guests a day, and actual visitors over last year have been about 3,300 a day, implying capacity utilizations are about 25% and thereabouts. This is the number one thing to do in Bangalore out of 320 things as per TripAdvisor. And based on 3,100 odd reviews, the rating is 4.5 star. So fairly good there. The financial performance has been exceptional. Revenues have grown at a CAGR of 26% over last 10 years. Uh, this is contributed by 13% growth in volumes, which is footfalls, and about 11% in revenues. Of course, year FI6 probably they did not operate for the full year, uh, being a new park, so there's a low base effect there. But even from FI7 when the footfalls were 7 lakhs, FI16 at 12 lakhs is a fairly good growth, at least in high single digits. In 2012, they also added a resort to this park, which has globally been the trend, right? Uh, so they added a 3 star resort by spending about 28 crores, and this has 84 rooms. It also has 4 banquet halls and amenities like swimming pool, restaurant bar, cuisine restaurant, multi cuisine restaurant. So the idea here is to make uh, the park as not just a picnic but a weekend destination, and also improve the catchment area so that people can come from far off locations. On a standalone basis, it resort or a hotel to me does not sound a great capital allocation, because the base rates are not so impressive, and ROCs in these businesses are generally poor. But given the synergies with an amusement park, a resort I believe was a welcome addition to Wonderla's uh, asset. And given the catchment area is 300 kilometers, as I said, people can come from neighboring states. Corporates can have weekend offsites and stuff like that. And that is also visible in numbers. In just 3 years, the occupancy levels have already crossed 60%, uh, and the average room rentals are fairly good. So they make about 4,600 per night. This company in 2014 came out with a public issue and raised about 180 crores. This was primarily to fund capex for their third park, to be started at Hyderabad, which is again in South India. So they had bought some 50-acre land in the year 2012, and they wanted to construct the park, for which they needed about 200 odd crores. Uh, they started constructing this park in early 2015, and by mid 2016 this was already up and live. So they have again a capacity to handle 10,000 guests here, and based on 9-month FY17 results, they had average daily footfalls of about 1,800. Given it's a new park, the capacity utilization here is fairly low. They've added 43 rides till now, 18 wet rides and 25 dry rides, and again occupied about 26-27 acres out of the 50 acres available. The capex on this park has been fairly high compared to Kochi and Bangalore, given the inflation, given the steep rise in land prices. So, and also location is fairly good. It is not very far from the city. It's a prime land, just about 20 kilometers from the center, 27 kilometers from the center of city, very close to the airport, just 12 kilometers. So they had an outlay of about 250 crores on this park. It is already 27th best thing to do in Hyderabad out of 240 things. Based on the ratings, 8 out of 10 people have good things to say about it, and the reviews have been excellent so far. Let's use this Hyderabad park to understand the unit economics of this business better. So based on how things shaped up for for Bangalore and Kochi, based on management guidance and based on what we feel is reasonable, we have assumed 7 lakh footfalls in year one, at an average realization per person of 900, which gives revenues of 63 crores, roughly $10 million in year one. The annual operating cost for running this park is about 40 crores, which gives them an operating profit in year one of 23 crores. There'll be a huge depreciation given the 250 crore capital employed capex done on the plant. Based on actual numbers, this works out to be 17 crores, which gives you a small operating profit and probably a loss at net level. This translates into an ROC of mere 2%. Uh, we must understand that this is a fixed cost business. All the costs are front loaded, whereas the utilization levels will only inch up slowly over next 2-3 years. So I've assumed 10% growth in footfalls and 10% growth in ARPU in year two, and numbers start to look better. The ROCs inch up to 7%. In year three, another 10% growth in footfalls and 10% growth in ARPU, and your ROC now looks reasonable at 12%. And from here on, I have assumed a 5% growth in footfalls and a 5% growth in ARPU, and see how ROCs tend to look much better from year three onwards. So that's the nature of this business, and That's how Bangalore and Kochi Park also uh, uh, o- o- they also had similar experience, and we believe that uh, though in the first and second year a new park puts a dent on reported financials, but it's from year 3 that the numbers start to look much better. The key question: what are the sources of economic moats in this business? First and foremost, I believe uh, the Bangalore and Kochi Park, which are prized possession for Wonderla, uh, is a major advantage. They have been able to build these two assets at a very, very low cost. For Kochi, they spent just $10 million. For Bangalore, they spent $15 million. Uh, if somebody wants to uh, build those plants today, build those parks today, the cost could be 5 to 10 times. Prime reason is because of the incessant run up in land prices. These low cost assets give Wonderla an edge to charge low ticket prices, and in turn, uh, be the cash cows to seed and grow uh, by investing in newer parks. This advantage is not would not be there with the new entrant today, uh, right? That's one. uh, the and look at Ad Labs, which opened one park couple of years back. That's the only other listed company in amusement park in India. So they opened one park on Mumbai Pune Expressway. uh, it's a huge park compared to Wonderla's standards, but they ended up spending 1650 crores capex on that park. Within the parks, they have a separate land park, water park, snow park, and for each they have to charge 1500 rupees per entry because of the huge upfront capex. So that's the advantage which Wonderla has because of the legacy assets. The second is in-house ride manufacturing facility. Given over last 15 years, Wonderla has uh, created 3 parks, have 120 plus rides in these 3 parks. They leveraged their engineering capabilities to manufacture rides in house. So 42 out of the 121 rides are manufactured in house. Uh, they have a qualified team of engineers, and the benefits are threefold. First, they are able to, based on consumer feedback, based on their uh, research done across the globe, they are able to innovate rides in house. Number two, they are able to manufacture these rides at one third the cost compared to the compared to the price if they had to import it. And finally, since the rides are manufactured in-house, the downtime and maintenance costs are fairly low versus if they were importing these rides. I think this is a true economic moat this company has, which no other amusement park player in India has, and a very difficult one to replicate because uh, they have 3 parks. They plan to open many more parks. So for them, it makes sense to have an engineering division in house. But for a new player, it would not make any sense to invest in the engineering plant. So so that's an advantage which I believe is very valuable and is expected to stay with them. They manufactured this ride called Sky Wheel, which is installed in their Bangalore park, and this is India's largest and tallest Ferris wheel. So this reflects the capabilities the engineering unit has. The next is their focus on safety, hygiene, maintenance. Consumers are getting more and more demanding, and rightly so. This this is a very professionally run organization, and they are obsessed about quality in everything. So they have 260 technicians who conduct daily, weekly shutdown maintenance using tools like checklist. They uses technologies like reverse osmosis to make sure water is potable, clean, safe. uh, they use extensive water filtering and recycling systems for each pool so that the quality is maintained. This is Wonderla is the only is one of the only 2 parks in India to have Bureau's Veritas certification, which is for the safety and environmental protection standards. And these are not just environmental friendly, but it lowers their operating costs too. So this is the only park to have a green establishment from Kerala State Pollution Control Board. They use rainwater harvesting extensively. They have two artificial ponds which stores 1.65 crore liters of water. They use solar energy. They use solar energy to heat water for all water-based rides during winter. All of these, they not only improve your uh, uh, guest experience, but also lowers your operating cost. All of this translated into a very strong brand equity. So if you see TripAdvisor's global ranking, uh, sorry, not global. In case of India, they are Wonderla's Bangalore Park is at number one, and Kochi Park is at number four. If you see the Asian rankings, again, both the Wonderla parks appear in the list of feature in the list of top 15 at number 8 and number 15 respectively. If you see globally, an amusement park's revenue profile is equally split between entry fees, which is the ticket you need to buy to enter the park, resorts, and food and beverages and merchandise. But in case of Wonderla, you see entry fees is almost 80% of the total revenues. The resort is merely 5%, F&B merchandise is merely 16%. Uh, you'll be surprised to know that Wonderla charges only MRP for all packaged foods, even sold inside the park. Uh, and this is very surprising, because when we go and watch a movie, uh, we are charged 10 times for those popcorns and nachos because we are a captive audience. You cannot go out during the intermission. You have to buy at the price at which they're selling. That advantage Wonderla also has of having that captive audience inside the park and probably giving them a lot of pricing power, but they haven't leveraged that yet. The idea is, because since they're focusing on lower middle class, they really want to make it a true value for money experience for their visitors. So they have been selling everything at MRP, which in a way is a low hanging fruit, right? Tomorrow, if they charge just 20% premium, that's a pure profit that straight goes down to your bottom line with zero incremental cost. Similarly, you saw how they opened a park resort at Bangalore, and quickly the utilization occupancy levels were at 60%. Given the synergies with the amusement park business, I expect them to open resorts in the other two parks, and also leverage F&B and merchandise uh, to increase revenue per visitor. So, so that's a great low-hanging fruit which is yet to be leveraged. They spend routinely 10 to 12% of their annual revenues on advertisement and sales promotion. They have a team of 55 agents who look after institutional clients like schools, colleges, corporate. Uh, there are roughly 1,000 schools in Bangalore. 800 out of them routinely have their picnics only at Wonderla. About 25-30% of the footfalls at Wonderla are school kids, and this is like an annuity business. It's a given. And after having added resort, it has also become the go-to destination for a lot of corporate offsites and other kind of gatherings. So in terms of seasonality, Q1 and Q4 are peak seasons. Q1 and Q3 being the Q1 being the summer vacation and Q3 being the festive season. Q2 and Q4 are relatively weaker, and they try to leverage institutional visits at that time by offering bulk discounts, which takes care of their utilization levels. Let's quickly go through Indian amusement park industry. What are the numbers? How many parks are there? So it's not very old. The first amusement park in India came up in year 1984 in New Delhi. Uh, and then it was followed by SL World and Nico Park in Mumbai and Kolkata in 1990s. It is still in the expansion phase. Total just 150 parks in the country. Uh, for the sixth populous nation in the world, uh, total revenues of the industry is mere 2,600 crore. That's it. This is nothing. Annual footfalls just 5 to 6 crores. That is less than 4% of our population. So, this is a very small number, because we are a very hot country. For 8 months, the climate is fairly hot, uh, and ideally, water park should be a very popular format. But looking at these numbers, it seems the penetration is fairly low and there's a huge headroom for growth. As per Care Research, huge investments are expected to happen in this industry over the next 5 to 10 years. Uh, Footfalls are expected to grow at 10 to 15% CAGR. Revenues are expected to grow at 15 to 20%. Uh, and the industry could grow multifold over next decade or so. Let's look at those 150 parks which exist. So I've divided the parks as large, medium, and small. Large defined by the capital investment these parks have, the area, the average ticket price, and number of visitors. So anything more than 40 acres, I'm assuming as large park, 10 to 40 acres as medium, and less than 10 as uh, small park. So there's just 16 to 18 large parks in India based on this definition. That's it. Some 40 to 45 medium parks and 80 to 90 small parks. I don't really consider them as as you know uh, uh, as, as somebody who's seriously uh, running the show. These parks are small standalone parks, not at all maintained. Uh, no well-defined processes for safety, hygiene. These are mostly in tier 1, tier 2 cities. They came up, probably they had, because the owner had surplus land, he didn't want to sell it, he didn't know what else to do with it, he just set up an amusement park. Or since it's a cash business, it gives you a tax entry. There could be other motives. I call this part of the industry as unorganized, and as these parks open up in more cities, they are going to lose all their share and die out slowly. So so just 30 to 40 serious players, serious parks worth counting for a country which has 130 crore of population, median age 26.5 years. And the beauty of the demographics is that 30% of the population is less than 15 years of age. That's exactly the target audience for an amusement park. And they're not going to go alone, right? They're going to take their families along. So this 5-6 crore annual footfalls can really grow multifold as per capita income grows, which is, by the way, inching towards $2,000 over next 3-4 years. And beyond 1,000 crores, the share of discretionary really rises fast. The other big tailwind is urbanization. Today, Indian urbanization stands at about 30-32%. Over next 10 years, it is expected to reach 40%. What that does is it increases the population in the catchment area of an amusement park, so gives you higher footfalls. These are very strong tailwinds, I think, which will work in favor of amusement park industry. And Indians hardly travel. We are, as a country, we hardly travel. Over last 10 years, though the domestic tourism has grown at 14-15% CAGR, but it is still nothing. I expect this to be a huge tailwind. And as people travel more, I think again amusement park is the most favored destination. So as the people travel more, I think footfalls should go up. The other thing is, for an average Indian middle class today, I think there is a serious dearth of entertainment avenues. Uh, think about it. What can you do? You can go watch a movie, you can go to a mall, uh, do some shopping, enjoy some meal at the food court. That's pretty much about it, right? There are not really many outdoor entertainment options which are affordable. So, uh, so at about 700-800 rupees per person, which is like $10 per person, for a family of three, that'll be just 3,000 rupees. You have an option of having a full day outing for your entire family. I think it makes a lot of sense, and incrementally, as the affordability improves, this will be the natural choice for a lot of families. Given kids love it, and people talk about disruption, people talk about 70, people talk about virtual reality, but I think this is bottom of the pyramid. This is the mid of the pyramid. These people are not exposed to such great things, or such luxury things, if I may call it. they are probably the first, they are visiting an amusement park for the first time, their kids are visiting an amusement park for the first time, uh, and you know, nothing really can beat the thrill of actually being there and enjoying with your family for a whole day. So I don't think there is much risk of disruption here as such, at least from in India perspective, and at least in the foreseeable future. So what are the growth drivers for this business? The first is from the existing parks based on rising footfalls. So you see last 10 years, footfalls have grown at a CAGR of 8%. Given parks are mature now, at least the first two parks, we can still assume a 4 to 5% kind of footfall growth over next 7-8 years. And capacity is not a constraint at all. These parks can handle 12,000 guests a day, each park, and the current number stands at about 3,000 odd. 40% of the footfalls are repeat footfalls. Uh, and to attract more people and repeat footfalls, the company keeps adding more innovative, more rides which are innovative, new, to create a buzz. So this year they added roller coasters in Bangalore and Hyderabad Park. This is India's first reverse looping roller coaster. Uh, it's a very smart, frugal management. They did not import a new roller coaster. So some parks were closing down in Europe, and they imported two of these roller coasters from some company in Netherlands at a fraction of the cost what it would have costed for a new roller coaster. And they are all over the social media. They've created such buzz about this, and uh, a common concern maybe for some investors could be that, hey, this is maintenance capex, something on the lines of Red Queen effect. Uh, just to maintain the footfall, they have to keep reinvesting a lot of money in these new rides. But I tend to think slightly differently here. So there are two ways to think about it. One is, uh, so this, let's say, addition of new roller coaster created a lot of buzz in social media, and a lot of repeat footfalls came looking at this ride. But you must note that they still paid for the entire park. These parks have one entry for the entire park, including land and uh, dry rides. So though this roller coaster attracted them, but they paid the full price. Number one. Number two, for a lot of people, the roller coaster attracted them, and they were actually visiting the park for the first time. So that contributed to growth in footfalls. Uh, so I would not agree that this is entirely maintenance capex. I would believe a portion of this is surely growth capex. And to again emphasize on my latter point, see, in Wonderla parks, at least 50% of the land parcel is still sitting idle. So every time they add a ride, let's say this roller coaster would have uh, utilized another 2 acres of the surplus land. So what this does is, during peak times of festivals, holiday, it let them accommodate more guests. So there have been days when Wonderla had accommodated 10,000 guests in a single day. What this does is, when you add 2 more acre and one more ride or two more rides, your peak capacity, your ability to handle many more guests at peak capacity goes up. So that way also, it looks to me as a growth capex more than maintenance. The third is hike in entry fees. So on an average, every year on April 1st, Wonderla hikes the entry fees by 10%. They've been doing it for last 10 years, and management is confident of their ability to keep doing it for a foreseeable future. See, India is a high inflationary country. Uh, it's not very difficult to, for a business like this which has so much pricing power, it is not very difficult to hike entry prices uh, by 8 to 10%. Beyond a point in time, it might be difficult for a 10%, but at least 5 7% should not be difficult, in my opinion, for a foreseeable future. Uh, Kochi Park started from 100 rupees, today it is at 800. Bangalore started from 250 in 2005, today it is at again 800, 900. And even if you assume a footfall growth plus pricing growth to be just in high single digit, both put together, the effect on the bottom line could be far superior because of the operating leverage. These are fixed cost businesses, and your incremental top line flows down to your bottom line. So a huge case of operating leverage here. Then the third driver could be sales mix change and value-added services. As I covered a while back, there are a lot of low-hanging fruit in case of Wonderla. 80% of the revenues are still coming from entry ticket. They can leverage F&B, merchandise, resort. So as they are able to increase revenue per user, per visitor, uh, their top line can grow all the more faster. They've already added resort to Bangalore Park, and I see no reason why they should not over time add resorts and leverage F&B in other parks. They introduced fast track ticket in 2013, uh, which essentially lets you skip the queue. They sell 300 such tickets in a day, and they charge double the price. So that's a value-added services, right? Uh, then recently, this became the first park in the country to introduce RFID cashless card. Because once you enter the water park and your money is all kept in the locker, you won't be able to spend, right? And Wonderla loses on all that uh, expenditure you would have otherwise incurred on F&B. So now they've introduced this RFID card. You can load it before you enter the park, and you can spend while you are in the pool. The final growth driver is addition of new parks. So they plan to add Chennai very soon. They are almost at the verge of closing the land deal. In next 3 to 6 months, I expect an announcement. Once they close the land deal, it could take about 18 months to construct the park, and by FY 1920, we should see Chennai being added to Wonderla's asset. So they expect to incur about 300 crores of capex here, 70-80 crores of land, and 200 odd crores on the civil and the rides. They have also signed an MOU with Andhra Pradesh government to add one park uh, sometime in next 5 years. Beyond that, they plan to add one new park every 3-4 years using internal accruals and some bit of debt. At no point in time they plan to go beyond one-time debt to equity. So, and he seems fairly, they seem fairly ambitious to become a pan-India player. So this will be a big growth driver as they keep adding new park every 3-4 years. Who is the person behind it? It's a gentleman called Mr. Kuchusif Chitilapalli. He started his first venture at the age of 27. He started a company called V-Guard, which is today also a listed company. It is one of the largest, fastest growing, most profitable consumer electrical companies with a market cap of $1.1 billion. Almost been 10 years since it is listed, and uh, in entire investment fraternity, in entire industry, it is a very, very reputed company, uh, very credible, very ethical. They treat minority with respect, great capital allocation, and I believe that runs in the DNA of the company, not just this gentleman, and I'll come to that in a while. So in the year 2000, he started first park at Kochi, and later on, his younger son Arun Chitilapalli took it over, which I'll cover in the next slide. He has sidestepped. He's fairly old now. He's in mid 60s. Uh, he's focusing on social work. He has an NGO called Thomas Chitilapalli Trust. He's actively working on education, healthcare, rural empowerment. Uh, he used to write a column in his corporate monthly magazine since early 90s, and all those letters culminated into this book called Practical Wisdom 1 and Practical Wisdom 2. I would highly recommend reading these. These are management lessons, very powerful, very simple, but very thoughtful. Uh, I would highly recommend reading these two. There's one more interesting bit I would want to share. A couple of years back, Mr. Chitilapalli donated his kidney. I think he was 60, 61 years old at that time. He donated his kidney to a random stranger, some truck driver, and the condition was that his truck driver's wife had to donate some organ to some other person who needed it, and the idea was to, in effect, hit a chain reaction across the country. That was his contribution towards, improving awareness towards organ donation in the country. Something remarkable he did, especially at that age. So his third book, which has recently been published, is called The Gift, and it talks about his experience of how he donated a kidney but gave away kidney but got a richer heart. Somebody whom I really respect, and somebody who has been a role model for many. His younger son Arun Chittilapalli is now looking after this business. His elder son uh, uh, is Mithun is looking after V-Guard. So Arun joined the company in 2003, right after his graduation, which he did in engineering, and he was the one who conceived the idea of Bangalore Park and executed it. He also obviously conceived and executed the Hyderabad Park. Uh, so he has been with the company for last 15 years. It's not that he has recently joined. He's still in his mid 30s, so fairly young. To me, he comes across as an intelligent fanatic. I met him a few times, and he has probably been to all the large amusement parks in the world. If there was a Guinness Book of World Record for a person who has visited the maximum parks, I would not be surprised if it goes to him. He's very ambitious about making Wonderla a pan-India player. He and his family hold 71% stake in the company, so there is enough skin in the game visible. How about balance sheet? So it has 428 crores of net worth as on September 16. Company has a net cash of 72 crore again as on September 16. Negative working capital because you get spot payments for the entry ticket. Chennai Park could have an outlay of 300 crores, and I think they would have to raise some 150 crores at debt. But they have categorically stated, and they repeatedly state in the con calls also, that they never intend to go beyond debt equity of 1, which I believe is very prudent and conservative, something I really appreciate about them. So post that, they plan to add one park every 3-4 years with internal accruals. I think should not be a problem. My guess is from next year onwards, they would be doing about 90 to 100 crores of operating cash flow every year. So every 3-4 years, they would have 300-400 crores kind of cash flow internally generated, which is good enough to add one park every 3-4 years. How do I think about valuation? That's the most important part, right? Uh, so one way to think about it is it's just a $300 million market cap company. Can this be a $1 billion or couple of $1 billion company 5-10 years out? Given it's a nascent industry, it is leader in that. Uh, they have a first mover advantage. The guy running the show is an intelligent fanatic, mid 30s, skin in the game, owner operator. Uh, I would tend to believe there is a high probability of that playing out. Uh, can it be Six Flags of India? So Six Flags is the largest regional amusement park player of US. They're known more for their thrilling rides, uh, and that way Wonderla is more of a family destination. So not comparing it that way, but can Wonderla be the largest, regional player of India of a scale of which Six Flags is to US? By the way, Six Flags has 18 parks, annual revenues of $1.3 billion, and a market cap of $5+ billion. So, from sub $300 million market cap, can Wonderla reach there in the next 10-20 years? I don't know whether that will happen or not, but I think there is a good enough potential and a good enough probability of that materializing. The other way in which most of us think about valuation is the traditional multiple based valuation, right? So at 380 rupees a share, if you see the trailing price earnings multiple, it is 58, right? That prima facie looks very steep. Oh my god, 58 is very high, right? Anybody would say that. But there are a couple of things one should keep in mind. Last 9 months have been pretty bad for the P&L of Wonderla. They capitalized their Hyderabad park. All the costs were front loaded. Capacity utilization is less than 20% as we speak. Uh, so given it's a fixed cost business, all the costs are front loaded. It was bound to hit P&L, operating deleverage, right? The utilization levels will pick up over next 2-3 years. That's when operating leverage kicks in. So this was on expected lines. That's why probably stock didn't correct at all. The other part is because of this 250 crore capitalization based on Hyderabad Park, there's a huge depreciation also added to P&L. Now, an important point to note here is that they depreciate on an average all their assets based on straight line method over a 8 to 9 year period. My estimate is the useful life of a lot of these assets could at least be two times, 15, 20 years. A lot of these are buildings, fixed structures, lot of rides which are not moving, stationary rides, the fixed rides, especially the structures and the water-based rides. I think because of that, P&L could be understated and maybe hiding the true earnings potential of the business. So I would tend to think in terms of owner earnings rather than the stated net profits in the P&L. So, and to do that, I prefer to look at operating cash flows rather than net profit. And based on that, it is trading at a multiple of 30 times. Uh, is it cheap? Surely no, but does it deserve it? I would say yes, because it's one of its kind business, and uh, as long as the execution is the way it is, there is no reason it should not command a scarcity premium. So, though I generally refrain from getting into next quarter, next year earnings to EPS to second decimal point, that's not something uh, I like to do. I prefer to be roughly right than precisely wrong. Uh, but I think we would fail in our duty as long-term investors if we don't even have a scenario analysis with some reasonable probabilities attached to them. So just for the sake of it, I have put up some uh, numbers, pretty conservative assumptions. I am assuming a footfall growth of 5% in mature parks. Hyderabad to add 6.25 this year. There were some one-offs, so instead of 7 lakhs, they managed to do only 6.25. 9 months are already passed, so I am assuming this will be pretty close to actual numbers. Chennai at 7 lakh in FY20, and these two new parks grow 10% for a while. Realizations grow at 5%, though management has hinted at 10. I'm assuming 10 for a couple of years and 5% from FY19 onwards. More or less, operating expenses are fixed and only increase at 2 to 4%, but I'm assuming 7%. No benefit of operating leverage thereby. Uh, Depreciation as is. I'm assuming 50% of the gross block for Chennai will be funded by debt at 12%, so 18 crores of interest burden from FY20 onwards. No benefit from sales mix change, no benefit from F&B, no monetization of excess land at Bangalore or Kochi or through resort. So those were my assumptions, and here's how numbers would look if we assume those things to be our scenario. So FY20 footfalls should grow to 40 lakhs from 27, uh, and net profits will only grow from 59 to 80. And if we see FY17, because of the reasons I stated, PNL has taken a big hit, so from 36 crores to 90 crores. But if you see cash flows, uh, from 67 crores, they are growing to 140 crores per annum. Uh, so I would tend to focus here more than here, and here's what we should keep in mind when we look at a company like Wonderla Holidays and a business like Amusement Park. See, they built two parks in 15 years, and they are repeating what they did in 15 years in next 3 years. With a capital outlay of as big as 550 crores, it is bound to hit their P&L. No two ways about that. So, one, as I mentioned, we are better off keeping our eye on cash flows rather than net profits. Uh, Once the fourth park of Chennai breaks even in FY 21-22, the numbers, reported financials, will resume high growth trajectory. From FY23 onwards, when they add one new park to four profitable parks, the effect on P&L would not be as steep as it is adding two new parks with such high capex on two mature parks as it would happen over next 3-4 years. Now in my previous slide, you can tinker with footfalls, operating leverage, realizations, depreciation, debt assumptions, and the numbers could be far, far superior. Uh, I think my assumptions are fairly conservative, and I would attach a high probability of these translating into actual numbers. It's a concept stock. I would want to. We are looking at it from a 10-year perspective, probably longer. And if you have a 2-3 year kind of view, I think you should avoid it. Uh, if at all, we have a long-term view only, then we should look at such concept stocks. But I think it has a high probability of creating some decent wealth over next decade or so. Look at other entertainment businesses in India, pretty richly valued. So PVR is the largest movie exhibition business organized player in India, trades at some 77 price to earnings. Uh, Multiple Delta Corp, the only listed player in casino business, trades at 45 times earnings. So I see no reason why Wonderla as a business should not command a premium. What are the major concerns in this business? One is obvious: any major accidents in the park because of any negligence or malfunction, which is attributable to Wonderla's management. So there have been deaths over the last 15 years, 9 major accidents, seven deaths, uh, uh, but they were mainly on account of cardiac arrest. 5 of those 7 deaths were on account of cardiac arrest. So and then I think it's given the kind of high quality processes these guys uh, have put in place, it's again a low probability event, and God forbid if anything like that happens, they are fully covered. They have taken insurance for guests, for employees, for their spouses, so all of that is covered. God forbid this risk could become materially bigger if some accident were to happen to one of their school kid visitor, because that would lead to mass withdrawals from all the schools, given the accountability of the school management. They would not want to take any such risks if God forbid any such accident were to happen. So that, according to me, could be a bigger risk. 30% of the footfalls are on account of school picnics. The other is on Hyderabad Park. They bought 49.5 acre land, but about 30% of that, one of the land parcels in that, is disputed. The management is confident of winning the case, but if they were to lose it, would not affect the current operation. Sorry, it would not affect the current operation, because they have constructed the park on the 27 acre which has clean title and which belongs to them. But it could impact the future expansion, and this is a business where, to add one or two rides also, sorry, you need uh, enough land available so that you can expand and add rides. Third is capital nature of business. So this is another common concern I keep hearing from investors, that it is a very capital intensive business. But and then that's a fact, right? And it keeps getting more expensive to open new parks. So Kochi, they spent 65 crores, Bangalore 90, now Hyderabad had an outlay of 250. Next year they're talking about 300 for Chennai. So this will keep going up because of inflation, land prices going up. The way I look at it is, as long as Wonderla is not borrowing aggressively to add multiple parks at a time, that is, they are being conservative in growth and using the existing parks as cash cow uh, to expand and open new parks. This is not a big risk. In fact, this is something good, as long as incremental ROCs are maybe from year third uh, are 15-20% and thereabouts, and then they keep growing. It can become a money spinning machine. If they generate free cash and not grow, what's the point? As long as the incremental return on capital employed is good and they have so much reinvestment opportunity, uh, uh, there is no harm, right, of it being capital intensive in nature. So in fact, the way I look at it is, if the bigger risk is if any of their parks, for whatever reason, fails. So maybe wrong choice of location, or because of some irrational competition. If at all one of their parks fail, uh, this company could go behind 2 3 years. The absolute loss would not be much, because you can always sell the land, shift the rights to some other new park. But in terms of opportunity cost, it could take the company 2 3 years behind, because during those time it will take away management bandwidth, and so opportunity cost will be there. So to summarize, it is a market leader with a first mover advantage in a nascent industry. It is a play on Indian demographics, lot of tailwinds in its favor, unorganized to organized happening. Idea has a huge longevity, I can think 10-15 years here, and the industry itself can grow 10 times over the next 10-20 years. It is run by an owner operator with skin in the game. He's in mid 30s, seems like an intelligent fanatic. It's a very ethical group with exceptional track record on capital allocation and competence. Uh, initiating position, I would not mind even buying at this valuation and then wait for time or price correction to build my full position. No stock goes up in one line. No matter how good the business is, they always face bumps every now and then. One should look for such opportunities to buy and add aggressively. Current valuations, I would not mind building my initiating position. So that was my thesis on Wonderla holidays. It is safe to assume I and Stalwart Advisors investors have position in stocks discussed. The stocks discussed were for illustration purpose only and not to be construed as investment advice. Please do your due diligence and consult your advisor before acting on it. For complete disclaimer, visit the link. Some more disclosures based on SEBI research analyst guidelines.